All right, today we're going to tackle a huge question, one that goes back something like 5,000 years. What is money, really? We're going to trace its incredible journey all the way from these ancient clay tablets to the numbers you see in your bank account today.
So, what do they have in common? Well, it turns out every single one of them is an answer to the same basic problem. How do we trade with each other? And what we're going to do is show you how these things that seem so random are actually just different chapters in the exact same story. It's a story of innovation, yeah, but also crisis. And it's all built on the one thing money absolutely cannot exist without: trust.
Okay, so let's rewind. Our story really kicks off thousands of years ago, in a world where there's no cash, no coins, nothing like that. Everything, and I mean everything, was based on barter. But you can probably see where this is going. As societies got bigger, moving from tiny villages to bustling towns, this whole system started to create a massive, massive problem. Just think about it. Imagine you want to buy a house, and all you have are chickens. You show up and say, "I'll trade you 50 chickens for your house." Okay, first, the person selling the house has to actually want 50 chickens, right? That's what economists call the double coincidence of wants. And even if they do, what if the house is worth, say, 25 and a half chickens? You can't just hand over half a chicken. Well, you could, but it wouldn't be very useful. The point is, barter was just so clumsy and inefficient. It was holding everything back. If we were going to build big cities and complex societies, we desperately needed a better tool. And here's the solution starting to take shape. It began with something really simple, these little clay tokens in Mesopotamia. Think of them like IOUs for stuff like grain or sheep. But then, over time, people started using metals, especially silver. Why silver? Well, it was durable, you could divide it up easily, and pretty much everyone wanted it. Now, these weren't coins just yet. We're talking rings and coils that were valued by their weight. But this was the birth of money as we know it, a universal way to trade, which eventually led to the very first officially stamped coins over in Lydia. But you gotta understand, this new world of money and debt, it had incredibly high stakes. Just look at this law from the Code of Hammurabi. It shows you just how brutally real the consequences were. Forget about a bad credit score. Back then, the collateral for your loan could literally be your wife, your son, your daughter. This wasn't just some abstract economic tool. It was a powerful and, yeah, often pretty brutal force that shaped the very fabric of society. All right, let's fast forward a bit to the Roman Empire. This is where things get really interesting because the state steps in and seizes control of money, turning it into this tool of incredible power. But, and this is a big but, with all that power came a really dangerous temptation, one that would pretty much define finance for centuries to come. For hundreds of years, the Roman denarius was basically the US dollar of the ancient world. It was a solid silver coin, and its value, its purity, was trusted everywhere. This single coin funded the Roman legions, it built the aqueducts, it powered this massive trade network. So the denarius wasn't just money, it was a symbol of Roman power, and more importantly, Roman credibility. So what happens when that trust gets broken? This chart tells the whole story. See, to pay for things like wars and fancy palaces, emperors started secretly mixing cheaper metals into the silver coins. They were debasing the currency. And you can see the result right here. The silver content just falls off a cliff. Now, people weren't stupid. They knew the coins were worth less, and so prices for everything went through the roof. This was one of the very first and most famous examples of state-driven inflation in history. Okay, so after Rome falls, Europe heads into the Middle Ages, and a totally new kind of problem pops up. On one hand, you've got trade networks that are getting bigger and bigger, but on the other hand, the simple act of lending money and charging interest, what they called usury, was condemned by the church as a mortal sin. So how on earth were you supposed to finance anything?
Well, enter the Medici family of Florence. Their solution to this problem was honestly brilliant. Instead of building one giant bank, they created something that looks a lot like a modern holding company. Each branch they had, whether it was in London or Bruges or wherever, was its own separate partnership. And this decentralized setup was the genius part. It limited their risk. If, say, the London branch made a bunch of bad bets and went bankrupt, it wouldn't drag the entire Medici empire down with it. It was a financial firewall.
And let's be clear, this was very much a family business, with all the drama you'd expect. This quote here about one of their managers is just perfect.
It shows that even these legendary financial titans had to deal with that one unpleasant relative in the office that everyone hated. It's just a fantastic reminder that behind all these huge world-changing financial systems, you've just got real people dealing with, real people problems. It's really hard to overstate just how big of a moral challenge this was for people like the Medici. The whole idea of usury, just charging interest on a loan, wasn't just a bad look. The church literally considered it a mortal sin. The whole argument was that money itself was sterile, right? It couldn't reproduce like a sheep or a field of wheat. So charging for its use was basically seen as a form of theft. To get around this, bankers had to come up with all these clever financial loopholes, like disguising interest as currency exchange fees or structuring loans as investments so they were sharing in profits, not just collecting interest. So the Medici model was perfect for a world of city-states. But now we're entering the age of empires, and the scale of everything just explodes. Suddenly, kings and queens need to fund massive armies, they need to pay for global expeditions, they needed a financial system that could operate on a truly national level.
And the solution they came up with? Central banking. It really starts in 1694 when the Bank of England is founded for the specific purpose of lending money to the government. A similar thing happens in the U.S. with the National Bank Act of 1863. It created a single federal system to help fund the Civil War. And the final piece of this puzzle was the gold standard. This was a rock-solid promise that every single dollar a government printed was backed by a real, physical amount of gold sitting in a vault somewhere.
And this setup created this really fundamental tension, a sort of tug of war between two competing ideas of what money should be. On one side, you've got the gold standard. It's disciplined, it's stable, but it's super rigid. A government can't just fire up the printing presses. It has to have the actual gold to back it up. And on the other side, you have this idea of fiat currency. That's money that has value just because the government says it does. It's way more flexible, sure, but its entire value depends on one thing: trust. And for a while, that discipline of the gold standard actually worked pretty well. But what happens when a system that's built to be rigid smacks head-on into the absolute chaos of 2 world wars and a Great Depression? Well, it breaks.
It turns out the gold standard's greatest strength, that rigidity we talked about, was also its fatal flaw. To pay for World War I, countries had no choice but to print way more money than they had in gold. Then, during the Great Depression, nations started jumping ship to try and save their economies. The final nail in the coffin, though, came in 1971. That's when U.S. President Nixon officially cut the dollar's link to gold. The gold window, as they called it, was slammed shut. And just like that, a whole new era began.
And that brings us right up to the world we all live in today, the age of fiat currency. It's just like the definition says. This is money that has no physical commodity backing it up. No gold, no silver. Its value comes entirely from our shared belief, our collective trust in the stability and credibility of the government that issues it. So yeah, that's exactly right. The dollars in our pockets, the numbers in our bank accounts, it's all basically a sophisticated social construct. It's a promise, an idea. And it only has value because you, me, and everyone else agrees that it does. I mean, when you really stop and think about that, it's kind of mind-blowing. The entire global economy is running on a shared belief. And this really brings our whole journey full circle, doesn't it? We saw how clay tokens solved the problem of barter. Then precious metals solved the problem of standardized value. Banking came along to solve the problem of commerce and risk. And finally, fiat currency solved the problem of rigidity. You see the pattern, right? Every single stage was an evolution, an innovation driven by a brand new challenge. Which, of course, leads us to the big question. What problems are we facing now, and how will they shape the future of money? That is the next chapter in this incredible story.